Fabio, the Institute's first white paper was on stablecoins, so it's good to have Heath Tarbert, the president of Circle, on the show. A little bit about Heath and a little bit about Circle. Heath has served as acting undersecretary of the U.S. Treasury for International Affairs, and he was chairman of the Commodity Futures Trading Commission, an agency which many forget regulates a variety of financial futures, such as the mighty S&P 500 contract. Heath was confirmed in that job in a Senate vote of 84-9, proof that the Senate, Heath, can muster agreement every now and then. Circle is the issuer of USDC, which is the largest, it's a large stablecoin, and they're the largest issuer of stablecoins.
We issue USDC alongside other stablecoins, and we like to say that we're the largest regulated stablecoin issuer.
Largest regulated stablecoin issuer. They also issue EURC, a euro stablecoin, and it's investing a lot in the payment backbone. Fabio, take it away.
Well, first of all, thanks for joining us. It's great to see you again. Heath and I overlapped very briefly at Treasury when I was there. So maybe it starts with a broad question for the people that are not familiar with what stablecoins are. What stablecoins are, what are the use cases? Is the technology, is the payment system, is the anonymity? Why people use stablecoins?
Yeah, so first of all, your white paper is really well done. So I would encourage folks to read that. That is really it's both has the academic rigor, but at the same time is also accessible to a broad audience. So that's a great place to start, but big picture, and I might even start even before we get to stable coins, just to talk a little bit about what is blockchain, what is this all about? And the way I explain it is the next iteration of the internet. Blockchain technology allows, through decentralized computing and cryptography and all this sort of fancy stuff, essentially the ability to move value over the internet. Just like in the past, we move data, we move video. Right now, we're broadcasting over the internet. But until blockchain technology was created, there was no ability to actually move value itself over the internet. That's the big revolution. So think about it as the third iteration of the internet, so-called Web 3, where essentially people can participate in blockchain networks, decentralized ledgers that allow value to be sent. So Circle was created more than 12 years ago on the premise by our founder, Jeremy Allaire, that what about if you could take money and you could send it as easily, safely, securely, 24/7, like you could send an email? Well, a stable coin is basically that. It is a tokenized version of the dollar. It's taking the US dollar and it's putting it on the internet. So you can send it anywhere at any time, just as easy as you can send an email. So when people are like, well, what is a stable coin? It is basically a digital asset that is designed to hold its value stable, and in the case of USDC, to be worth $1.
A little history, Fabio. So 5 years ago, the Fed was discussing and experimenting with a central bank digital currency, correct? And then there was political pushback over that. So we've decided the private sector, companies like Circle, should be the dollar digital currencies, tokenized dollars. So, and you have political tailwind now. We have the Genius Act that passed. That's sort of enabling legislation. So what do you have to do next now that you have this legislation?
Yeah, and I'm so glad we have the legislation, because essentially from our vantage point, we've been advocating for uniform federal standards now, as well as regimes that are very similar to the Genius Act in countries around the world. Because in order for this to work, in order for you to be able to send $1 as cheaply, safely, and efficiently as you send an email, those dollars have to truly be stable. There needs to be a rigorous regulatory regime. And so long before the Genius Act, Circle essentially asked ourselves, what will it take to have the highest utility form of money that people can actually depend on? And so we said, well, it needs to be backed one for one with basically dollarized assets that are safe, highly liquid. It needs to be transparent. So someone needs to understand exactly what the reserves are at any time. And we need to have third-party verification or assurance. And so all of those things now are built into the Genius Act. The Genius Act is not yet implemented. And so what's next is this implementation period. The regulators have about 30 important rules to write to implement the Genius Act. And so we've essentially kicked off that process now with the first set of major questions about the legislation due in the next couple of weeks.
And these are banks and bank regulators. Or are they all regulators? SEC?
It's the Treasury Department and then the banking regulators primarily. There are aspects where market regulators will weigh in, but another important point that the legislation clarified, though the SEC for its part said that stablecoins that had certain features are not securities. They announced that in April. The Genius Act pretty much codifies that and says if you're a payment stablecoin in compliance with Genius, you're neither a security nor a commodity. You're essentially a payment instrument. And that's consistent with what we're seeing around the world where they're basically calling it e-money. In the European Union, it's called e-money tokens. And so that said, though, there are still a lot of things that need to be worked out in the legislation, but it's an exciting time.
A question in terms of estimates where this is going to go. There's a wide range of number. I think right now we are short of like 300 billion. There's a lot of wide ranging from 1 trillion to 3 trillion without picking a number, or if you want to pick a number. But what is the main driver? Like, is it, again, it's just a payments technology? Is about building an ecosystem on top of it? Is about the anonymity? Is what's going to drive this growth?
Essentially, trust and utility. And so it's a variety of use cases, some of which are sort of signaled in the Genius Act itself, which essentially says that, one day Genius Act compliant coins are likely to be treated as cash for accounting purposes. So you can think about treasury management, companies that have things all over the world. Payment use cases are in today. Circle has the Circle Payments Network, where literally it used to take 72 hours to, let's just say, move a unit of currency from Asia to Latin America, translate it back into, let's just say, Brazilian reals, and take 72 hours. We can do it in 72 seconds. There's payment use cases. There are folks all around the world that, as you know, from your background and the IMF and from Treasury, folks want to hold US dollars, but don't have access to dollar bank accounts. Now, if you have a phone, you have a wallet, you can hold dollars in a way that you couldn't before. Obviously, the digital asset markets themselves are a place where these stablecoins first came into being because people were trying to buy highly volatile assets and they needed to move in and out of a currency that was internet native to be able to buy those. So those markets continue to grow. But the biggest use cases, I think, are going to be the traditional financial markets now utilizing this technology for things like collateral, merchant acceptance payments, treasury management, and all sorts of other use cases, in addition to use cases that we have no idea yet because they haven't been invented.
I'm going to speak for consumers here. Do you see a world where in my bank account I will have a deposit of stablecoins and a deposit of dollars, and I can choose and buy and sell seamlessly and decide I'm going to pay that with stablecoins? It's much easier than going through the traditional banking system, or I want to pay that with dollars.
Yes, I mean, I can certainly see that. In fact, I think banks are sort of, under the Genius Act, banks have the ability to issue stable coins out of a subsidiary of their insured depository institution. But really, I think banks will likely want to do is create wallets. Create wallets for their customers to enable their customers, as you said, to be able to have their traditional bank deposits in one pot, but be able to hold stable coins for use cases that make sense with stable coins. And banks will still be around, and we can talk a little bit about that. They still play a critical role in credit intermediation, something that stable coins really don't do because they're focused on payments. But you could obviously see a scenario where there may be certain things that you want to pay with stable coins because they don't charge interchange fees. You might be abroad, of course, and in that case, it would take it, or you need to actually have the money hit the account much sooner. Use stable coins for other things, you may use your bank account. And of course, the bank account in the vast majority of cases, will pay interest, something that stablecoins don't do.
I think the wallet is key because right now I have to transfer dollars to a wallet. And I think there might be some resistance by people like, who regulates this wallet? And is my money safe? Is it FDIC insured? No. So don't you think?
Yeah, absolutely. And so the market structure legislation that we're working on that will cover the rest of the digital asset markets may address some of those issues. But it is important, I think, that the private sector step up, particularly large trusted institutions, and start offering wallet infrastructure. So one of the things that Circle does is we do have wallet infrastructure. So we work with some of the largest institutions in the world, particularly those at this point outside the United States, to help them develop wallets so they can offer them to their customers, so their customers can hold something like a USDC alongside their regular deposits.
One use case that I was meeting some people during the IMF World Bank annual meetings that came was from the corporates, like corporate treasurer. And the example they made was like, today a corporate treasurer may hold, I'll make up numbers here, 20% in like deposit with a large bank and 80% in money market fund. Forward 2-3 years, that same corporate treasurer will hold 20% in stablecoin and 80% in tokenized money market funds. It's the same kind of like concept from an economic standpoint, but it's a very different speed, very different technology. And that was something I didn't think about in those terms.
Absolutely. We already know one large international financial institution that's using USDC to manage its cash management program throughout its operations because it's a global institution. So there are many use cases.
I think where the use cases will come, what kind of investor that matters for U.S. Treasury, right? So if demand comes from, say, international investor, emerging markets, that presumably it's new delta positive for the underlying reserve. So if they hold reserve in T-bills, that means there'll be demand for T-bills.
Yeah.
If you come from inside the U.S., then it depends what you're swapping, right? You're moving from a bank account to stablecoin, and you're coming from money market fund to a stablecoin. Do you have a view on where the demand inside the U.S. would come? So I think it's important for Treasury when they think about additional demand for T-bills.
I think that'll be determined by the use cases, right? The two are linked. So the more folks, for example, that are interested in using, USDC, for example, as collateral, those folks may move out of funds. But I do think ultimately the international use case right now is the most pressing, and therefore there will be a net positive both for treasuries as well as for bank deposits. Circle, for example, has billions and billions of dollars that we put right in the U.S. banking system. And to the extent those are funds coming from abroad, it's actually a major gain for the deposit base in the U.S.
One angle, again, part of the discussion during the IMF, which I didn't think about. I attended a couple of events from the financial market utilities, and a lot of that discussion was 2 points. One is like used for stablecoin for collateral management. But related to how they should think about positioning themselves in being able to use those. The other issue was if there is fragmentation though, so banks are issuing their own stablecoin, you have non-banking entities issuing, that fragmentation would make their ability to use this as collateral and netting much more complicated, right? Because you are just competing stablecoin.
That's why we don't think there's going to be, in the long run, thousands of US dollar stablecoins. We think there will be some that have because basically you need two things to have a successful stablecoin. And it's taken us years, by the way, for Circle to build this. First, you need trust. That comes from compliance, transparency, all those things that we said. The Genius Act goes to that. So those that are compliant with Genius should have the trust factor settled. The second part is utility. And utility comes from liquidity. And so Circle has an established network of on-ramps and off-ramps around the world. We're on 28 different blockchains, more than any other stable coin that's out there. 28 blockchains where we're native. And we also have the ability to create bridges to have effectively USDC, a bridge version on other blockchains as well. All of that builds out the utility. One of the examples I like to give, I was at the Fed the other day, and I said, look, trust and transparency is really important. The euro is a trusted currency, right? The euro is a solid currency. I know it's worth something, stable value. But if I gave everyone 20 euros and said, today, go to Ronald Reagan Airport and buy your meal with a 20 euro bill, it'd be very difficult because it doesn't have the utility. And so that's why I think folks may try to create their own stable coin and get it out there. But if it's only available on one or two blockchains, it's not available in other countries, people can't move in and out of it, it's not interoperable, I don't see it taking off.
Is the network effect and the liquidity network bucketing the people are concerned, right? That if you get to the network and you start getting liquidity fragmentation, actually it's worse because it makes it much more difficult.
Yes, and so one of the things that we do also at Circle is we spend a lot of time with developers. So we are working with developers so they can build applications that are based on USDC. And that, again, strengthens our network effect. So it's available all around the world, but it's also in various products and applications, similar to like your iPhone with lots of different apps. And so that's again, all of these things. It's simple to sort of issue a coin and say, well, we've got $1 backing every coin. It's the rest of this stuff and building out the network and getting those network effects, which is the hard business of stablecoin issuance.
Fabio and I were discussing, what I read is stablecoin issuers are working on something like a credit card backbone payment where you can protect yourself against fraud, where there isn't immediate payment and you can't get your money back. It's refundable. Can you tell us, are you participating in this and how far along are you?
Yeah, so maybe, and I'll even back up a step to talk about kind of our infrastructure project. And the main one that we're working on is called the ARC network. So what we found is that while there are many blockchains out there and they do great things and they're multi-purpose. So for example, again, as I mentioned, we're on 28 of them natively and we're investing in those ecosystems. For institutional grade, enterprise grade transactions, including the ones that you just mentioned with credit card companies, there are a number of features of traditional blockchains that just don't, in our view, satisfy kind of the needs of an enterprise class. And some of these have been pointed out, by the way, by CPMI IOSCO, by the BIS. And so what Circle undertook to do, because again, a lot of the projects are geared towards DeFi and some other applications. And we asked ourselves, if we were going to create an enterprise grade blockchain, what would it have? So the first feature is sub-second deterministic finality. And that's a fancy way of saying when you send the money, you know it's going to go through. It's not probabilistic. There's not a chance of it being unwound. You don't have to wait 12 minutes. So that's critically important, but most blockchains don't have that. Second feature is dependable gas fees, the ability to pay for transactions. And what we're going to do is do it in USDC, or at least have the option. So you can do it for a penny or whatever the amount is, and you know what it's going to be, and you don't have to invest in this myriad of tokens that are volatile in value. And then the third thing is the one that you mentioned, which is folks that are involved, that are enterprises, that are doing serious trading or managing the cash of their financial institution that has global reach, aren't going to want to show the entire world on a blockchain. These are all the transactions I had. So having a security or privacy feature is really important. We find that in the credit card industry, and also having an application layer that allows for things, for example, like sort of reversibility. And of course, I use that in quotes because the underlying transaction is not reversible, but you can build in an application protocol where people opt in that under certain circumstances, a reverse transaction is executed also on the blockchain that, again, is incontrovertible, but effectively puts people back to where they were to deal with fraud, refunds, etc. And so all of that you can build on top, and you can do this because of the programmability.
Which is all I was doing this morning. I saw on my credit card, there were some weird charges from the DC Metro. And so I ended up calling them up, and I was like, what if I was paying stablecoin? What would happen there?
Yeah, and so if you're on most networks, it would be very difficult. But one of the things is that if we get more and more enterprises to use something like the ARC network, for example, and we build protocols that allow for certainly participants to join it, these are the sorts of things that could be factored in.
Can like this instance of fraud, could you?
It wasn't a fraud in the end. In the end, it was just we used the cards.
It was your kid. It was
Someone else in my family using the card.
Using the card. Yes. Yes. Right. So you can imagine, and this is an example of just one of probably thousands of applications. Again, think about the iPhone and or your Android, and think about all the apps that you have on it that do various things, whether it's your airline or whatever. These are the sorts of things that can be built on top of a blockchain.
So we have a friend of the Institute, Matteo Maggiore. Maybe you know him. He's a kind of a leading light in geoeconomics. After reading his work and talking to him, it seems to me it's in the U.S. interest to have a couple of dominant stablecoins, just like it's in our interest to have the dollar for network power. Is that what you expect to happen?
Yeah. So Circle, in many ways, is an internet financial platform company. So just like you have internet platform companies like your Googles and Amazons and others that are built out, I think we see the growing internet financial system as being an opportunity to build a platform company where people are not only using our stablecoin, they're part of our stablecoin network, but they're building on top of us. And in those industries where you have platform companies, you normally do see sort of a winner take most kind of phenomenon. And you see not necessarily not monopolies, but you definitely see like 3 or 4 big players or something like that. Yeah, just because of the scale and scope and the investment that it takes to build the world's largest and most widely used stablecoin network, it's just not feasible for a number of banks to try to do that. So only a few of us will probably set off with that proposition in mind, and also saying that we're not going to do a bunch of other things. There are tons of other applications. There are other protocols that can be built that do essentially anything in the current financial system can probably be tokenized in some form or another and have a smart contract deploy it. And so we're going to leave a lot of that stuff up to others to build, but we want them building on top of ARC and the USDC stablecoin network.
I'm smiling. I got to say this, Fabio, because we had a nice blog. What exactly is a token? Is it a future, a derivative, a security? Maybe you have an answer as a former CFTC chair.
Well, as they taught us in the very first day of the very first class of law school, in most cases, the answer is it depends.
Also, economists use that. So.
Right. And all things being equal is another great one if you want to, sort of put that at the end of the answer. So it really depends on the features. I think if something is effectively tokenized cash, like a stable coin, I think the United States came down right, which said that's a payment instrument. That's not part of the commodities markets. That's not part of the securities markets. But if in fact the digital asset token has features where essentially you're dependent on a small group of folks or a group of individuals who are operating it as an enterprise such that you need to rely on them for it to go up in value, then that looks more like a security.
I want to follow up on the issue. You mentioned this like network effect and how like there will be 2-3 winners. And think in terms of bucket of competition, if you want. Like, so one could be from the banking sector, right? With the banks create a consortium and create one banking stablecoin, or the fintech world, right? You can think of like the Amazon of this world creating their own stablecoin, then they can have rewards, I can use them to pay. Where do you think the most pressing competition may come from?
And it remains to be seen, though I will say that the Genius Act has an important provision that creates, at the very least, a pretty onerous speed bump for non-financial public companies to be able to get into stable coins. And so if you are one of those big ones that you mentioned, that is not already a financial institution, they're not predominantly engaged in financial services, they have to get approval by the stablecoin committee. And so I think that's essentially Washington's way of saying we're not necessarily comfortable with that. That said, I think there are a lot of opportunities for those companies to partner with a company like ours. And so that is what we're looking, because again, to be financially regulated, many of these companies just culturally, I mean, they've done amazingly well. They've been leaders in Web 2. They are a big part of many of our lives, but most of them have never been regulated financial institutions. And so culturally, I think that's going to be a major adjustment, notwithstanding kind of the barriers that Genius puts into place. So we view them as really potential partners, but it is possible they could get into this business. On the other hand, we have the banks, and sort of the traditional financial institutions. I think the issue there is in some ways the opposite. They've obviously gotten used to being regulated, but to be a cutting edge internet native company is not something they're used to. Many of them are still programming with Fortran and whatnot. And so it's not to say that they couldn't, but I think, again, given the scale and scope, it is difficult to build out a global stablecoin network. The other thing they have to worry about is their deposit base. And I think they're going to be very concerned about if they come out with their own stablecoin, how much of that's going to eat up the deposit base. And again, stablecoins are extremely conservative. The yields on them are meant to be pretty modest because they're backed one for one. And so compare that to their regular leveraged portfolio of commercial real estate and all the other things that banks invest in to get much higher yields. That's going to be a really difficult decision to sort of cannibalize their own deposit base. And so again, also too, it's very unclear. A company like Circle, I think we've got a number of different financial institutions and other firms. You may have seen when the ARC testnet was released yesterday, we had over 100 different institutions saying they were sort of participants in that network, a number of which were international global financial institutions. They feel comfortable using something like a USDC. They might feel less comfortable using their competitor's coin and vice versa. So it's really remains to be seen whether some of the largest banks may issue their own stable coin, but my guess is the rest of them may not.
Can I ask you about risks? A couple of different points. One is about run risk. That's one thing we try to highlight also in the paper. Clearly, the Genius Act versus non-Genius compliant reduced the run risk for a number of various reasons, including the reserve, the transparency, the trust. It doesn't entirely eliminate it, obviously. There's no public backstop. But I think more the question I'm interested in is more, could you see there is a risk that a run on a smaller player may actually generate a run on the bigger? So you could be the most conservative setup, have all the thing in place, and then some newcomers, smaller one, generate a broader run.
No, it's really important, actually. It's very important because not all stable coins are stable. Not all stable coins are equal. And so one of the reasons we pushed very strongly for the Genius Act was to lessen the possibility of that. Because, of course, now in the United States, any old stable coin can be effectively listed on an exchange and it can be backed by virtually nothing. So the Genius Act should reduce that risk. But even Genius Act compliant coins, if they don't have the scale and the utility, there's still a chance, not necessarily that they would break their peg. And of course, when I talk about the peg, I'm talking about the issuer itself always redeeming one for one. But if you don't have the global network and the liquidity, you're not on dozens of blockchains, it's entirely possible that a secondary market dislocation is a lot easier in your case. And so that is something, but I think that will shake out over time. And that's why for us, it's critically important that being a public company, being as transparent as possible to be able to communicate to the market, regardless of what's going on with stablecoin X, USDC remains solid. We stand by USDC. We're regulated. One day we'll be, we can say we're compliant with the Genius Act when that's implemented. All of that is critically important. But I do think you're going to see a period where a lot of folks jump into the stablecoin Me Too thing, and it doesn't work out for some of the reasons we've discussed before about scale and network effects, but also just because they're not able to get the liquidity and there's just not the demand.
How do you see the interest ban? In some ways, it looks to me in the Genius Act, it looks like an artifact of bank lobbying. And now you can go on Coinbase, migrate over to Morpho and earn interest on US dollar coin from a network, and you don't even know who that network is. I'd much rather have Circle pay me interest than some anonymous blockchain, to tell you the truth.
Yeah.
So do you think that'll stand? What are we going to do with this?
Yeah, so Circle's always been of the view that a stable coin, to truly be a payment stable coin, the equivalent of a tokenized cash, should not pay interest. However, if you do want interest from Circle, in your case, you're a U.S. citizen, but one day will be available, we offer a tokenized money market fund. So we are cognizant that there are market participants out there in the world that say, well, I want to hold a yield-bearing instrument. And our view has always been, that makes a lot of sense, but that's not a stable coin. That's a security. And in our case, we have a tokenized money market fund called USYC. It's currently available outside the United States. At some point, it may be available inside the US, but that was a way of addressing that point. What the act does allow is, so you can't, a stablecoin issuer can't pay a holder of a stablecoin interest merely through the holding of the stablecoin. However, we have commercial distribution arrangements where if a large exchange or some of the companies that you mentioned, the big commercial companies, wanted to say, look, we'll enable USDC for our customers or whatever, we can pay them commercial distribution fees to enable that or whatever. They then have a choice as to what to do with the fees that they collect from a circle. And sometimes they may pass it on, sometimes they may not. But my view is that's ultimately a secondary market issue. But I think our view is the payment stablecoin issuer doesn't pay interest.
So I have a follow-up because, and I got to ask this, Fabio, because we're going to have an art blog on it. USDC is often used to buy Bitcoin. It's the digital currency to transact in other cryptocurrencies. And it seems to me that this blog will say, if that's all it's used for, then it's dissemination as payment. And if we get to earn interest above market interest in these arrangements where people are borrowing our US dollar coin, paying us high interest, collateralizing the loan with Bitcoin, then why would I ever use it for payment? I would just go out and earn 5% on my US dollar coin on some channel like Morpho. So this gets to the tension of, if that's what if it's this digital native thing that is used for digital transactions of other digital currencies, doesn't that militate against becoming a payment coin and disseminating?
Yeah. So I would say up until recently, and even today, the primary use case is purchasing and selling digital assets. That has been true, no question about it. But what we've seen in the last few years is a decoupling of the digital asset markets from stablecoin usage. So, for example, when we see major dips in trading and in volume on exchanges, we still see stablecoins going up. People are still using more and more stablecoins, which tells us that the payment use cases, the store of value cases, and the commercial use cases are now taking effect. And with Genius, we expect that decoupling to be even greater.
I've seen some research, I'm not going to name the investment bank doing that, but trying to essentially address this by looking at what they call high velocity versus low velocity. High velocity being, financial institution, they use it for payments, it's for trading, versus low velocity would be, the emerging market holder that you want to have dollar exposure. That's a good way. And for Circle, that share of high velocity was actually growing essentially, which means the use case is more the payment as opposed to holding it for speculation purposes, which I think is the same point that you just made.
Yes, and I think with the potential treatment of USDC and other compliant stablecoins as cash, with the use of USDC, the derivatives markets that I used to oversee as CFTC chair, as variation margin and maybe initial margin, use in wholesale payment systems, all of those things that the Genius Act opens up, I think you'll see, even if the volume of digital asset market usage goes up with stablecoins, as a percentage, it will go down because all of these traditional financial use cases, as they move on chain. Plus, you'll start to see new on-chain products that don't involve that are not traditional digital asset buying and selling, but all sorts of protocols that essentially replicate traditional financial services. Those are being built as we speak.
One question then I want to ask you about digital finance, maybe to close, from a European standpoint, right? One of the risks that some of the policymakers there have highlighted is that if, take Circle in this case, right, you issue dollar stablecoin in the US, and then from the European headquarters, you issue dollar stablecoin there. Their concern is that if there is a run on that stablecoin or that stablecoin issuer, people would run to Europe because their regulatory regime is stricter, the speed of being able to take the money back, it's faster, and also the collateral, it's more bank deposit. Like for large share I have my doubt personally that I would want to run to a place where there are bank deposit behind vis-a-vis place where someone has T-bills, but that's my own personal view. I don't know if you have views on this issue in terms of brands.
Yeah. So, and there are sort of two ways to solve it, one of which is currently being deployed. And really the concern, though, is that it is really important that for something like USDC, that's on 28 different blockchains around the world, that has a liquidity network globally, that there is one USDC, not a USDC from America and a USDC from Europe. And so and the European Commission was pretty clear on this in MiCA, that there can be a dual issuance model. So essentially USDC is USDC, and we can redeem it anywhere in the world. We don't necessarily have to. What we do, of course, in Europe with Circle France, so USDC is issued by Circle Internet LLC, which is our sort of New York or our US-based entity. And we also have Circle France. They both issue USDC, and we're constantly ensuring that there's reserves for both, and we're moving reserves globally back and forth.
Those are portable, like
Yes, exactly, and that was very important to us. So if you're if you're a global French bank and you buy USDC in Europe, but then it ends up in New York and you want to redeem it with us in New York, you should be able to do that. Otherwise, you're going to have the fragmentation of liquidity. So we manage it very carefully, and we're managing it as sort of a global reserve, but we meet the French requirements. And so we make sure that we have certainly sufficient amount in France. We're in great sort of dialogue, regular dialogue with ACPR and our regulators in France, as well as our regulators here in the United States. And so that's the solution we have, because MiCA requires onshore issuance. Where we could move to, though, in certainly for other systems, so for example in Japan and other places where USDC is permitted, it is just issued out of the United States. And so the Genius Act has a provision, of course, that allows reciprocity and recognition. So the other way to solve this, apart from making sure the reserves are managed on a global basis and going back and forth and making sure the liquidity is there, is just simply to have recognition of the jurisdiction. And so USDC would be issued from the United States, but there would be agreements in place. There'd be pre-positioning of liquidity, but the regulators would recognize each other's regimes as being equivalent. And that way you would also avoid the fragmentation of liquidity. And the idea that USDC issued somewhere is different than otherwhere, it would just be issued in one place.
So I think the fragmentation of liquidity is the worst enemy here, right? Because it completely undermines the entire concept or this global.
Yes, and we comply with the law. So that is the law in the European Union, that you need to issue it onshore. So we're issuing it onshore. Now for EURC, or Eurocoin, it is issued in France and only in France.
To me, the way I think of this is like stablecoin are like the first building block of this ecosystem of digital finance, right? The payment system.
Yes.
Then you have financial market infrastructure, thinking about using as collateral. Then you have the tokenized world of digital finance, whether this is money market funds, like you said, whether it's T-bills, equities, credit. I can think of like opening up liquidity in private markets, for example. Where do you see this going? How fast this is going to go? That's the big question. I don't have doubt personally that this will happen. The question of speed, it's a big one.
Yeah. I mean, I think it's starting now. So you're seeing, they call it RWAs. And for those of us that have been in the Basel world, RWA means risk-weighted asset. But in the digital asset blockchain world, it means real world assets. So it's essentially taking everything today and tokenizing it, securities and things. So we're already seeing that now. Tokenized money market funds are taking off. We're already talking about other tokenized securities. There's been things in the news where a major financial exchange has said we want to start working on this stuff. So I think it could take off very quickly.
And you when you're in your public sector life, you mentioned Basel, for example. How should, in this world, though, where everything becomes tokenized and global and light speed, how should the regulator, FSB, CPMI, BI, how they should think about what is their role in this new world? Because that gets much more difficult.
Yes, but the short answer is they need to start thinking about it. I know they have. But the old way, I mean, there was a period, though, I would say in the last few years, particularly in the United States, which was sort of like, well, just pretend it doesn't exist. Let's ignore it. Let's not encourage it. but the technology is here. It's like the countries that said, well, let's ignore the internet. Let's not advocate for it. Let's not build it into our systems. But it happened, like it with broadband and everything else. And so I think they have to start thinking about, what does the new financial architecture look like? What does an on-chain financial system look like? And what is the role of regulation? And I think my view, and I think Circle's general disposition has been, for this to work and work well, there has to be sound regulation. There has to be sound regulation. And so while the technology is new and different, and just sort of taking statutes that were written in the 1930s and then applying them doesn't probably work, that doesn't mean that all the lessons we've learned in the last few hundred years about financial distress, about financial stability, about fraud, everything, those lessons can't be imparted here and built into a new framework.
I have a closing question, Fabio. You mentioned, you read something, Andrew Bailey said maybe we'll have stablecoin loans.
He was trying to make the point that you can separate, essentially, banks could be narrow banks where they essentially, they're in the payment system, but the credit creation function that today is in the traditional banking sector could actually move over to the NBFI system. And that would be building on top of having more stablecoin or digital. I'm simplifying his article, but that was his point. Like, banks could be narrower, credit creation happens somewhere else, and then you have this technology layer on top of that. That was, I think, is...
So if we have an interest rate on a stablecoin loan, does that imply cash has time value? Stablecoin has time value.
It's a digital version of the same concept, I think.
Okay.
Yeah, and so the answer is yes. If the stable coin is literally just simply a tokenized dollar, then there could be folks that lend out those dollars and charge interest. In fact, there's a charter. There was just a provisional charter granted for an OCC national bank that intends to do precisely that. That loans will be made in stable coins,
100% backed by dollars.
Yeah, well, they will take for example, they'll take USDC. They won't issue the stable coin. Rather, they'll take stable coin. Someone will buy USDC. They'll go to their bank. They'll deposit the USDC in that bank, and then the bank will loan it out, just like a regular banking relationship.
Like you do with fiat money.
Like you do with fiat money. But the programmability, the ability to do it allows them to do things with stable coins that you may not be able to do with regular sort of bank deposits.
I see. So I was confused. I thought the bank would hold a dollar reserve from your dollar deposits. That would be the reserve, and they would issue a digital asset, which they would then loan.
So that in some ways is tokenized deposits, purely tokenized deposits. We haven't talked about that, but we could end on this note, which is there are three kinds of digital dollars. There's the central bank digital currency, which would be like a Fed issued instrument or Treasury Fed, probably the Fed. I think we've decided we're not going down that road for a variety of reasons. That's probably another show, which some of your former colleagues could talk to. The second kind are stable coins, back one for one. That's the path the United States has clearly chosen. We have the Genius Act. The third path is actually just taking our current fractional reserve banking system and tokenizing it. Right. There is a line in the Genius Act that refers to tokenized deposits, and my personal view is I think a lot more work needs to be done to be able to, before a decision is made, to take the banking system, which is, some people have argued, is fragile by design, right? It has a maturity mismatch built in. It has and then it has central bank liquidity facilities and deposit insurance to back that up. But now you're taking that banking system and overnight, you're going to turn it into a 24/7 movement. That could have a potentially really destabilizing effect. So I think a lot of work needs to be done in that area before we can actually tokenize bank deposits.
I think that concern would be, and maybe we can end on this, in a world where everything is digitalized and tokenized, not having a central bank digital currency, which is the easy way for a central bank to render last resort function, missing that piece in a world where there's also tokenized deposits, I think there are friction built into a system.
Yeah, so the argument would be essentially, you can't have tokenized deposits unless you have a CBDC.
Exactly.
Yeah, and if that's the case, then I think stable coins is probably the most prudent approach for the time being to tokenize dollars.
Heath Tarbert, the president of Circle, thanks for doing our first in-person podcast.
My pleasure. So great to be with you guys.
Thanks for joining
Thank
us.
you.